Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at everything you need to know in 90 seconds at 9 o'clock with news of floods, of Chinese travellers and US debt. But first up, the US Fed is about to report on its first meeting of 2018 and the last one chaired by Janet Yellen. After this is to be chaired by Trump appointee Jerome Powell, who is regarded as a bit of a rate hawk. Markets are expecting the next 25 basis points rate hike at their March 22nd meeting. This weekend we'll get the next US non-farm payrolls report, and today we got the precursor ADP report, which was strongly positive, handily beating market expectations, and it showed employment gains to be in the service sector as particularly strong. Right on expectation was the December home sales report. Volumes are up a mere 0.5%. More than the same month a year ago, but most of this growth is coming from southern states. Other regions saw volume declines. Prices are up 5.8%. The latest tax code revisions has lowered individual tax incentives for housing. North of the border, Canada has reported stronger economic growth in November. GDP there is up 3.5% and above market forecasts. It is across most of their economy's sectors. A curious pattern is developing where the US's main trading partners are reporting stronger growth than for America, which is turning out to be the laggard. In China, they reported that the expansion of their manufacturing PMI grew less vigorously in January than December. It isn't expanding particularly impressive anyway, so a slowdown will worry them. But their consumers are in an expensive mood. In a hard-to-believe but eye-catching report, it has claimed that 92% of Chinese consumers plan to travel overseas in 2018. That is 154 million Chinese international travellers, up from 122 million last year. A real flood is coming to many parts of the world. And back in the US, the Federal Treasury is hiking the amount of new debt it needs to raise. Basically, that is because it needs to pay for its stimulatory tax cuts. And the new extra debt is not insignificant. Expect a blowout in their overall federal debt levels. It is only a matter of time before markets see American fiscal policy as irresponsible, and that realisation will buffet financial markets for some time. Buyers of that debt will demand higher risk premiums. And don't forget, we're just 2 weeks away from the next budget resolution in Congress. Actually, that's the budget resolution for October 2017. Given the hard and partisan positions in yesterday's State of the Union speech, it seems they are in for a very rocky period again. Meanwhile, the rest of the world is trucking on. In fact, global trade is in a real purple patch at the moment, with air freight volumes up 9% in 2017, the highest level ever and the highest growth rate in 7 years. US Treasury 10-year yield is still firming and is now at 2.74%, a gain of 1 basis point. And oil prices are down marginally today, but still just under $64.50 a barrel, while the Brent benchmark is now just under $69 a barrel. And gold is unchanged, still at $1,340 an ounce. But the Kiwi dollar starts a little higher today, at 73.7 US cents. On the cross rates, we're still seeing small rises there at 91.4 Aussie cents, and against the euro at 59.4 euro cents. That puts the TWI at 74.4. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.